Hey, hey, hey. I hope everyone is having a wonderful Sunday, getting ready for tomorrow. Um, I'll wait just a couple minutes before we get started, but we'll be doing some debt consolidation talk tonight. So, looking forward to talking to everyone, but we'll give it just a couple minutes, let people join, and go from there. How's everybody's weekend so far? Matt, how's St. Louis? Mr. Carr, thank you for joining. It's always a pleasure. Everybody have a good weekend so far? Yes, it is crazy hot outside, and yes, it is wedding season. What's up, Darren? Um, hey, Lori. Mine was good, Darren. Mine was good. We had a family reunion, kind of, for Courtney's side of the family. Not really a reunion, just went up, saw her grandpa. So it was good. Went up to a place called Memphis, Missouri. It's right on the borderline of Iowa, Illinois. So way up there. All right, let's go ahead and they always do, don't they, Lori? They always go too fast. Let's go ahead and get started. So tonight we will be talking debt consolidation. Or I guess I will be talking debt consolidation, and we're talking really what is debt consolidation and maybe why you should do it. What are some ideas, things of that nature. I'm amazed at how many people don't know what debt consolidation is really. They've never heard of it, never even really considered it, and it can actually be a really good way or tool to make your money work for you, honestly. So, if you look up the definition of debt, um, that is the state of owing money. So, something that typically is owed or due. And then consolidation is unification or uh, let me see, the instance of consolidating. Mr. Kyle and Ray, hopefully, I don't know which one it is, but hello. Um, so it's consolidating debt, obviously. So it's rolling debt. So maybe think of debt. It's not getting rid of debt. That's not what debt consolidation is. Debt is still going to be debt, but by consolidating debt, the idea here or the purpose is to turn maybe higher interest rate debt or what I call bad debt into better debt. So roll it, maybe transfer it from a 15% interest rate into a 3 or 4% interest rate. A lot of people don't even know you can do this, and this is why I wanted to talk about it. I had a question last week after I talked about the savings 101, and I thought debt consolidation would be a great topic to discuss and talk about. So, and if you guys have any questions while I'm talking, please feel free to ask. That that's really what I prefer. But so either way, some ways or ideas on how to consolidate debt itself. So the first there's different ways of doing this. So the first one, let's just say you have a high some credit card debt. That's probably the worst debt or highest interest rate debt most people have anyways. Credit card debt, in my opinion, is it should be capped. The federal government should probably cap interest rates on credit cards because it's kind of like legal loan sharking. Some credit cards have 22, 23% interest rates. I would tell you the average I look at is between 14 and 17. But you can actually get other credit cards and roll your credit card debt that was owed on one into the other. And the only reason you would do that is if you can find a credit card that has a 0% interest rate for the first 12 months. So you can roll debt, the credit card debt, from one credit card that you were paying 17% on, for instance, into a credit card that's free for the first 12 months, and try to pay that down as much as possible because that's 0% interest. That's an amazing way to do that. That's one way. The another way is obviously if you have equity within your car. So let's say your car's paid off. Let's say you have a 5, 6, 7-year-old car. It's paid off, but it's still worth quite a bit of money. Why not refinance your car, since interest rates right now on a car are 2, 3, 4%, and do a cashback refi. So you're going to get a loan on a car for whatever term period that fits your budget to pay off on a monthly basis. You're going to take the cash that you get. So let's say you have $5,000 in credit card debt. We're going to cashback refi on a car. We're going to get $5,000 out of our car. The bank's going to write you a check for $5,000. You then take that check and you pay off your credit card debt. So you just transferred 17% interest rate into 3% interest rate. Pretty good. It's a pretty good concept and idea. Like I said, the debt is still there, but what you're doing is you're basically minimizing the interest rate that you're paying, which is the whole point of debt consolidation. It's turning bad debt into better debt. Another way that people do this is refining a house. I think refining a car is your better option because a car is simple interest rate, whereas a home, it's a longer term typically. It takes a longer amount to pay off. So over time, you are going to pay more in interest. But still, a lot of people will use their home if they have equity in it, and you can do a refinance. You can do a home equity line of credit, a home equity loan. So there's different ways to go about it. Home equity line of, let's see, would you recommend consolidating student loans or just paying off the higher debt ones first? Well, that's a great question, Matt. So everyone's situation is going to be different, but if you have something that you have equity in that you could get cash out for a lower interest rate and pay off the higher interest rate, why wouldn't you do that? That would be my question. But you have to have the equity. That's the problem that some people run into. Great question though. But obviously, if you can't consolidate, then yes, you're going to focus on paying off the higher interest rate loans first, trying to get those paid down, because the higher the interest rate, the more you end up paying over time, and so on and so on. So it doesn't allow your money to work for you. But either way, going back to refining a home, either a home equity line of credit, which is a really good option, no closing cost. A line of credit is a line of credit. So if you have X amount of cash that you can access, you get to it, you pay the debt off, then you pay your line of credit back. Typically, and right now rates on homes are in the 3s as well, if it's a low enough term, in the 2s. So just go from there. Anyone else have? I was able to consolidate all of mine student loans. Very cool. Yep, that's great, Cindy. Yeah, which is amazing. So you went from paying. So student loan debt varies anywhere between 6 and let's just say 7-8%. You took 6% debt and turned it into 3% debt. That's good. Like, good for you. Great job. That's exactly what That is the whole entire purpose of debt consolidation. Um, so so hopefully you guys are figuring out the the why behind it, what it is exactly, and that's my purpose tonight, to tell you what it is exactly, give you some ideas. So the credit card, rolling it into a credit card with 0% for 12 months, refining cars, refining homes, um, home equity line of credit. And then, so I also want to talk about, however, are habits. So you buying and saving habits. Consolidating debt is an amazing thing, but the one of the things that I've seen and that I have a conversation about with all of my customers and clients I help when I do help them do this is we don't want to consolidate your debt just for you to go out. We don't want to get rid of credit card debt just for you 3 or 4 or 5 months later to get another credit card and rack up a $3, $4, $5, $6, $7, $8,000 worth of debt again. Like, that's not the purpose of this. So let's consolidate your debt. Let's roll it into a lower interest rate, make it a manageable monthly payment, allows your money to work for you, and also let's start working on, if I don't have a car, home equity, where can I go to find out about consolidating? That's a great question, Josh. So you can go to someone like myself. Different companies out there offer debt consolidation tips. I'm just covering the basics tonight. A lot of times, but the easiest and most effective way for the consolidation is if you like your car, or think of a credit card. So if you don't have equity built up in your home or on your car, the first option I said with getting another credit card with like a 0% interest rate for 12 months is a fantastic idea and tool to use. So that's a great question. But back to the buying and saving habits. So you want your money to work for you as good as possible. So let's consolidate the debt, and then let's work on habits. So you're going to want to work on your buying and your saving habits. So by breaking your debt down into manageable monthly payments, make sure you're taking a portion of those, because you just cut it down into a monthly payment. Let's make sure that we're also starting to save some money. Let's make sure we're not creating the same bad debt that we had in the first place. I understand things come up, and that a lot of times that's what happens with credit card debt, or hospital bills, things of that nature that really do hurt people's credit that you can't really help. Things do come up. I totally get it, but we want to try to work on making sure that it doesn't happen again if possible. So that was one thing I wanted to touch base on, because consolidation is definitely a quick fix, but you also don't want to have a quick fix and then get yourself back into the same issue or problem that you had. So that is debt consolidation at its finest. So I just really wanted to let people know what is debt consolidation. So it's consolidating your bad debt, higher interest rate debt, and moving it into debt at a lower percent interest rate. That's the whole purpose of debt consolidation. Taking, for example, a credit card at 15% and rolling it into maybe a vehicle loan of 3%. So you just saved yourself 14% in interest. That's good. That's just one example. So that's what debt consolidation is. I gave you different ways to do it. So the ways, like I said, credit cards with 12%, with 0% interest rate for the first 12 months are great options. Refining, if you have equity in a car or home, looking at refining a car, home equity line of credit, refinancing your house, which, by the way, while we're on refining cars and homes, I would recommend, if you haven't refied your car or house here lately or looked at rates, do that. Right now, the mortgage industry the rates are super low, and vehicle rates are pretty low as well. So if you guys are looking to save some money there right now, and with the industry, it's a great time to do it before interest rates hike it back up. Good stuff. Hope all is well, and we'll have some questions. Thanks, Matt. Is that vodka? That's water, my friend. That's water. All right. Does anyone else have any questions? Anyone? Again, I appreciate all of you. Appreciate your support. Appreciate your you joining in, asking questions. We're gonna make this an every Sunday ordeal. Sunday Smarts, and then Weaver Wednesdays, of course, 7 o'clock both nights. But Sunday Smarts is all about your investments, finances, basic insurance. And the whole reason I'm doing this is because it's, one, to just educate people, help people out, let them know that there are things out there like this that can help them. Two, I'm educated in the subject matter. This is stuff I do on a daily basis, and I'm not here to persuade you or sell you on anything. I'm purely doing this as an informational and education standpoint. So thank you guys. If you have any other questions, remember, what's the topic for Weaver Wednesday? Great question, Justin. I don't know yet, man. You'll have to talk to the boss. She Weaver Wednesday is kind of our thing. I leave it up to her for the most part about what we talk about, or of course, if we get an instant message or a question about something to talk about, that'll be the topic. So we haven't really discussed it yet, but hopefully you'll still tune in on Wednesday. But anyways, Wacky Weaver Wednesday. I like it, Darren. Touch a bit on a few major things to avoid when borrowing money. When borrowing money, so that's a great question. So there's multiple ways to borrow money. The first thing you should avoid is a bank that doesn't report to the credit reporting agencies. So there's a lot of small town banks out there that do not report to credit reporting agencies, which is ridiculous, because then that means that you get no credit towards that loan with other banks that do pull your credit from the credit reporting agency. So you want to do business with a bank that is going to report to like Equifax, and there's two other ones, if that makes sense. So that would be the biggest thing I would tell you to avoid. Secondly, make sure that your interest rates are good. I mean, we live in a very competitive interest rate market. Bank of Odessa is the one. I think, Justin, they used to not. I think that they are now. I'm not 100% sure if Bank of Odessa reports now or not. I've been told that they do, but I know they used to not. So that's my biggest thing. Get your interest rates. Make sure when borrowing money. So depending on what you're borrowing, there could be fees. So make sure you get a breakdown of what the fees are going to be, because I see a lot of banks charge super high fees or unwanted fees. And those would be the three things I would tell you. Do business with someone you trust, obviously, when borrowing money, reputable company, reputable bank, if that makes sense. Great question. Any other questions before I go? If not, we'll be wrapping this bad boy up so you guys can get back to your Sunday night adventures and getting ready for the week. Any other questions, guys? All right. Well, thank you all again for your support. Appreciate all of you. Appreciate all of you that jumped on and asked questions. Hopefully all of you have a fabulous, fabulous week. Make it great. And yes, that's Royals just started. And again, thank you guys. Have a fabulous week. Make it great. Have a good night.